All right, everybody. Good afternoon, or in this case, happy Friday. It's the week before July 4th, and I had somebody reach out to me in my DMs on Twitter, as believe it or not, some people do. And they asked me specifically, Matt, you've alluded to how your perspective and portfolio and what you invested in has changed over time. And I want to give everybody the opportunity to kind of listen in a very short, succinct manner, and have the ability to tie back to it. Because I've mentioned it on podcasts, I mentioned it through several videos, but those videos might be talking about dividends, or might be talking about palantir, or might be talking about, and it might not necessarily be focused on how I've kind of come up with my investment strategy and what I generally give to people in terms of thinking about when you're investing, how to best appropriate your strategy on your own, because it is personal finance and everyone needs to think about it from a personal perspective. So I started the workforce back in 2012, 2013 time frame, kind of in the full time. 2012 was an internship that I had here down in Houston, Texas for an oil and gas company. And then I got hired back in 2013 with that same oil and gas company. Things were fat and happy, right? Oil prices were above $80 to $100 a barrel. Things were looking great. It was basically just right after this big run up in oil prices from the $20 to $30 a barrel range. Then you had 2008 where things went to 140, then it skyrocketed down. Not too far after that, 2009 because of the GFC, and things kind of equalized again back at the $80 to $100 barrel range, and things were fat, dumb, and happy. And I actually just talked about this on a podcast with Tevis. But the thought process was like, okay, oil and gas, great place to be right now. Oil prices are good. People need oil. The economy is expanding. All these great things, right? And then boom, I just got my finances in order, and then boom, the hit of the cyclicalness of oil and gas really starts to come to mind and starts to show its true colors. By early 2015, oil prices were down around $30 a barrel, and people are starting to lose their jobs in front of my eyes. Here I am, a 23-year-old kid, thinking I had the life by the balls, and it was really going to be a very easy life, making pretty good money for the next 20, 30 years. And now I'm literally seeing people in front of my eyes losing their livelihoods, having to go home to their families and unfortunately tell them that they no longer had an income and they had to figure something out. And I was one to be like, I'm going to be proactive. I'm going to put my elbows on the table. I'm never going to be caught with my pants down and not have an income. And so, when I first started investing 10 years ago, it was very unfocused. I'd invest in Sony, then I'd invest in San Juan Trust, and I'd invest in things that provided dividends, or, very speculative biopharmaceutical companies like Novogen, or began with an O maybe, or something like that. And ONGO or something like that. I don't even know if it's around anymore. And I was just like, after starting to see people lose their livelihoods, I was like, you know what? The only way I can guarantee it is dividend investing. And so I went on this dividend investing kick, investing in high quality, or what I perceive to be higher quality dividend paying stocks, a lot of energy stocks, trying to get that dividend income up by a couple $100 a month, if not thousands a month. In case if I were to lose my job, I'd at least have a place to live off of my dividend income, or not have to get kicked out or anything like that. So that was the goal. And I kind of lived by that MO. People would be like, Matt, you're losing out on so much opportunity cost. And at the time, I was so blinded by what I had seen in 2015 and 2016 again, with further layoffs, that I was like, I don't care what the stock market is doing as long as I'm getting my dividends. And I was very blinded, and I shut everybody out. And I should have listened to some folks basically being like, index funds of the way, index funds of the way, index funds of the way. I was fortunate, I would say, to be in the cyclical industry and not have to be impacted. I have been impacted, let's just say, in pandemic time came around. I was living in Trinidad and Tobago, and I was supposed to stay there another few years. And then unfortunately, or fortunately, depending on what lens you look at it through, I was able to come home about 6 months after the pandemic really started. So by the end of 2020, I was living back in the United States after a short stint elsewhere. But that being said, like, the job market and my seeing of the cyclical nature of some of these companies has really shaped my idea on what investing was like very early on in my career. And it wasn't until I got into like the 2018, 2019, after meeting a few other people that were getting lucky and fortunate into buying into Tesla, and they had that forethought, and Tesla emerged as a profitable company, and they did really well with that, and seeing how these companies truly started to perform and grow and do well made me realize is like I'm being short-sighted and being blinded by what's going on in front of my eyes, when in reality I need to have a longer term vision. And I started to recognize is like I went from making nothing in dividends to, in a shorter amount of time, making over $20,000 a year in dividends. And then I started to realize I was like, well, if I ever truly needed the dividends, I could always sell the principal on whatever companies or whatever I own and move it over. It was getting to the point where, I was getting closing on $500,000 or so. And I was like, you know what? If I just keep down this dividend path, sure, I'll hit $100,000 in dividends a year. I might hit $200,000 in dividends a year. But I was like, I'm never going to get out of like this big slump of basically living the lifestyle that I currently am. I would only transition from, hey, I have a working income, to now I have this dividend income that sustains that sort of lifestyle. And it wouldn't be until I invested in, not say super high growth stocks, right? I'm not looking to go from say $500,000 a year to say like $500 million a year. That's not the goal here. But the thought process was, if I could go from 500,000, I thought like if I was dividend investing, I'd probably end up at like the $2.5 million mark, which would provide me a pretty good income stream. Specifically, if you focus around investing, you might make a couple $100,000, or maybe like $150,000 a year in dividend income off of that 2.5 million, 3 million, to going to something where I was like, you know what? Like, I think with the income that I have, being so young, having a decent sized portfolio that I've amassed to over 7 figures at this point, if I focus it appropriately, after a few doubles in the market, going from say 4,000 on the SPY or the S&P 500 to 8,000 to 12,000, it'll get me to a place where 8 to 10 million is something that's pretty achievable. And that, to me, being 2.5, 3 million in wealth is great. But really, to change my circumstance and change the way that I live and my lifestyle, we really need to get to that above $5 million range. And that's kind of getting to the point where you have way more than just being able to buy a house and a new car every few years and having that sustainability of like normal, independent, like financial freedom, to now being a point of like more affluence and being able to go on trips and really not have to worry about money, right? And that was kind of what was like, I have an opportunity here at my age. I think at the time it was like 27, 28, 29, to be like, okay, if I transition to that and focus a little bit more on a balanced approach, I'll be able to get to that $8 to $10 million range prior to, kicking the bucket. And it made me really think that that was more of a flexibility. And if the case needed to be where I needed to focus back on dividends, say I lost my job or what have you, I still have that underlying principle that I can then use to get back to that sort of dividend income amount. And so that was really the transition and the recognition of why I transferred to the way that I did. It was like hey, I need income today. I'm not going to get caught with my pants down. Then I realized that I was fortunate to not have lost my job through the last 10 years, even though it's a very cyclical nature. And I've seen several downturns, and who knows, how 2023 is going to end up. Are we going to stay at $70? Are we going to continue to go down to 50s, 60s, 40s, what have you? And it might end up in another sort of recession in terms of the oil field, and I might have to, hold up my job again. But I've been fortunate to weave through and maintain my job throughout this last 10 years. And with that, it made me realize, like, depending on the circumstance, perspective, your objective, and that's really where I started to come up with the 5 things that I always talk about, which are important to understand where you fit. And it always changes, right? It's something that you have to think about 6 months, a year, after every sort of major event that happens in your life, how does this change your perspective? How does it change? And it's a constant thing that you need to like keep. And it's like a portion of you, right, that you need to continually monitor and have in retrospect, on the back of your mind, so that you're always making the right decisions. And that's objective, time horizon, risk tolerance, how much you're going to add to your portfolio all the time, and you know, how much active or passiveness do you want to add to your portfolio. Some people might say they want a really hands-on investment. Real estate's probably the way to go. Or they might say something like, I don't have the time to plunge toilets or flip a house or anything like that. Then, real estate is probably not for you. So it all kind of goes down to those 5 key things. And every investment agency or, wealth advisor is probably going to ask you the same thing. But yeah, that's kind of the story. That's kind of the transition of how I went from, penny stocks to very quickly being dividend stock focused to now being where I am, which is, a dividend part of my portfolio, but mostly invested in the S&P 500. It's probably over 30%. You have like S&P 500 equivalents that might pay a little bit more dividends that probably get me to the 500,000, if not a little bit more range. And then you have the remainder of the portfolio probably being in dividend stocks and speculative positions that I have that I anticipate are going to grow. Not necessarily the dividend portions of the stocks, but the individual securities, generally speaking, when I invest in those. Palantir, Rocket Lab, I expect them to eventually grow into several $100,000 positions, if not $100,000 positions. And so that's kind of the MO that I go on these days. And anything that has grown or matured enough where I'm like, I'm probably not going to get the massive expansive growth that I really want, which Pepsi's kind of getting to that point, and Johnson & Johnson as well. Do I sell those off and just keep them in the S&P 500? Yes, it might eat a little bit of dividends in the short term, but the long-term growth potential might eventually allow it to catch up. So anyway, just a little bit of a food for thought, but wanted to share that with you guys, and hopefully that this video always finds you guys well. And I'm going to take care of some errands before I have to shoot Palantir Weekly, but I hope this one was helpful, and I'll see you guys on the next one. Cheers.